take the opportunity to review the week past and the week ahead. And as of Friday, oil markets closed down on Friday a little bit, but generally up quite strong through the week. Let's kick off with Christoph Ruhl, regular Sunday commentator, senior research scholar at the Center on Global Energy Policy at Columbia University. Good morning, Christoph. There's two sort of very contrasting data points out of Asia last week. One is, of course, the bionic China economic growth figures for the first quarter at over 18%, unprecedented, never seen before, all of the expletives, if you like, superlatives. But the other data point, which is just coming out this morning from India, yesterday, over 265,000 infections in India, people dying in parking lots, the hospital system in the major cities completely overrun. Two major diverging realities. Which one wins out this outlook for the coming period? You're on mute. Sorry, Christoph.
Oh, sorry for that. Good morning, first of all.
Good morning.
Funny that you put it this way. This is what I actually jotted down when I was thinking. First, last week, nothing much happened. And then what's the big picture? And the big picture is really one where I would put this diversity or this bifurcation on top. So you have one part of the world with stellar recovery rates. And I mean, they are from a low base, that explains it. But you will see numbers. So you have seen never before coming out of the US, the UK, basically the vaccinated part of the world, and China is part of that. And then you have a bad part of the world, which is not only India, but also includes places like Europe, where you have consequences in terms of going high up on the misery index in terms of low economic growth and bad health consequences from the pandemic, but where you also will now see political consequences as far as these countries are democracies. In France, elections are coming. In Germany, elections are coming. And the pandemic and the mishandling of the pandemic is going to change the election outcomes there in ways which we haven't seen before. And then, of course, you have these places like Turkey, like Russia, and to some extent also like China's naval maneuvers, who are trying to find their foot now after the pandemic, also contingent on how well they did, but in trying to figure out ways forward, which strongly are impacted by whether they have a pandemic problem or not, and whether they need to distract attention or not. So by and large, we will have countries like the US going into an inflationary problem, into creaking supply chains. We're already seeing this going into overdrive. I would add China to that. Nobody is talking about inflation in China, but of course, last year everybody talked about debt in China. So there is something brewing there as well, given that massive demand which now comes with the economic recovery. And then you have countries on the other hand, which are not only suffering economically, but which gives rise to geopolitical tensions. And we see this coming up in the Turkish neighborhood. We see this coming up in Russia's neighborhood in the border to the Ukraine. And most of all, we see it up in sort of the louder tone in the rivalry between China and the US on the South China Sea.
Walter Simpson, managing director of CCD. Walter, the reality is that we're seeing the markets follow the big growth numbers, the GDP, the China. Although surprisingly, I suppose China when the news came out on Friday of the China growth figures, it didn't really bump up the oil price on the day. But nonetheless, the markets seem to be following, and they have been for a while, the positive data points of recovery, and to a certain extent ignoring the still sort of blistering headlines like we're seeing out of India.
Look, I think it's very true, Sean. I think the growth in China was startling, but surprisingly, I was reading this morning and I hadn't noticed that it actually underperformed prediction. Prediction was 19% and it was only 18, so to speak. So I mean, maybe that's why the oil price didn't react quite as much as you might anticipate. But we also got the forecasts that the production is going to recover. And so I think, the markets are looking at a longer term view than they believe the short term is hard in some countries particularly. But they think we'll get over that as vaccines start to get around the world. So I do suspect they're ignoring the shorter term, really, and thinking longer term and looking at the data for that.
I mean, in Oman, where you're operating, you've also had another lockdown. Infection rates are soaring there as well. How does that potentially impact your business ability to operate?
It's been a tough week, actually, if I'm honest. Keeping enough fit and healthy people to be able to run our operations has been a challenge over the last 10 days, that's for sure. Infection rates here are very high. The vaccination rollout has been slow because of access to vaccines by the country. And so, yeah, it's been a tough few days, I must admit. We're seeing the level of infection rates that, you know, other parts of the world are seeing at the moment, and it's tough.
Christoph, we had reassurances perhaps on Friday from the Russian Deputy Prime Minister Alexander Novak, who heads up the sort of OPEC plus oil policy there, reassuring that the commitment to proceed with the increases in the second quarter. Do you think the market needs that kind of reassurance, or will it be looking for more supply given these demand outlooks?
No, I don't. I have to come back to your first question on that.
Please.
I agree with Walter. This is not a situation where we have stellar growth or falling off a cliff for the global economy. I do think this is a situation where we have stellar growth in one part and a delayed reaction in the other. So in other words, I do believe that eventually everybody will come around to get the virus under control. I mean, we will have to learn how to live with it, but vaccination has changed the game. So we have to, that's the first point, keep our eyes on the ball, and the ball is still the corona situation. If there is no big mutants emerging, maybe a big if, I have no idea, but I assume not, then that is a situation which will gradually come under control. And so from there, it follows that most of our problems have to do with economies staggering into a state of overheating and with the K-shaped recovery, the poor getting poorer and the rich benefiting. And that creates a lot of problems. I mean, we are seeing now container markets, rental rates going through the roof because supply chains are creaking. People are writing op-eds on that. I wasn't following that really closely. Last week, we tried to order a new kitchen for this house in which we're here holed up. And everybody tells you can't get anything within the next 3 months, only after that. And then you will get the kitchen, but there will be either the oven missing or the fridge missing or this missing or that, because they are completely maxed out.
We can bring you a car, but it will have no wheels.
Yeah, I mean, it's amazing. Now, that kind of supply chain problem will at some point, if it's serious, we are very good as a world economy to fix that, so it will not last. It doesn't really worry me, but it could affect, of course, temporarily energy and creating some bottlenecks. Similarly, the big picture for energy is one of rising demands, but there will be some quiet parts of the water like India, so where that will take time. So Novak was probably just saying that we're holding the course because he sees a similar picture. The sea is a bit choppy, but the stream goes clearly in one direction, to put it that way. Then there are the big unknowns, and this is also interesting, which is still inflation now for the market. Last week forgot it, next week it comes back, so that goes up and down. But we are seeing prices in some areas creeping up and in others not. So, for example, somebody made this comparison. Lodging in the US prices went up 8%. Rental rates, they went up 1% or 0.1%. You know, big diversity. That, of course, is a legacy of the corona things. And what worries me is that people like Paul Krugman, who would always sort of preach there will be no inflation, everything is going to be fine, let's spend some more money. They're now going public and saying, actually, we need a new inflation measure. So literally, we don't need inflation and core inflation where we take away food and energy because it's very volatile. We need something core inflation, which sounds to me like if the problem is so getting so serious that I need a new measure, then
well, you've already got a new measure, don't you? Because they changed the parameter of inflation being an average of 2% rather than actually 2%. That was a year ago.
That's the target, yes. And these kind of things, fiddling with targets, fiddling with definition, that's bad science for Joe Sixpack like me who watches on the street and things. And that, of course, matters because we have a totally overheated stock market in that upper K part of the world. And that is really also, it's also a mystery to me how long, I mean, there's this wall of money and that explains it, but the crash at the end must be tremendous. So how will this ever be adjusting? I have no idea. It's really a journey, getting a journey in the unknown. So the long and the short of it is that we are moving into an overheated situation, which is largely unknown. And that's the prime destination for most of the things we are concerned about, like energy. Unfortunately, some people are coming late to the party or falling by the wayside, but that will not distort this big picture, bad as it may sound.
Walter, the other sort of two stories we have in the digest looking back to last week, and it sort of maybe points to the coming out of this COVID pandemic period where we have Aramco announcing plans to resume work on offshore oil capacity expansion, the potential to add over 1 million barrels of new capacity on some offshore fields. Meanwhile, U.S. oil drillers, a big story in the FT, a kind of a big feature review about the shale outlook being again very negative, and the essentially the shale producers being cut off from access to capital, signaling so that the demand outlook for coming out of COVID rests, it would appear, very much with the national oil companies like Aramco and others, and less with the likes of the shale oil. Your thoughts on that outlook going forward?
Look, I actually agree with the premise. I think the national oil companies are going to be the driving force for the oil output in the future. I do think the way OPEC has managed with the Saudi drive to control supply to make the oil price do what it wants to do is a lesson to the likes of the shale players in the US that they're going into a market where they can be taken out of business very quickly by a big player if they choose to be. So I think there's definitely been a change in the way things will be looked at going forward around how safe a bet on shale production is going to be in the US.
As a smaller producer on that sort of long piece of string, the outlook for spending the capex required to add capacity, is it there in the Gulf? Are all of you, and obviously at the small end, but obviously at the big end, we're seeing Aramco. Does this follow right through that there will be the budgets there to add capacity?
So look, again, it depends on your cost of supply, really, and clearly Saudi has the cheapest cost of supply. So clearly there's going to be the capital to invest there. I'm comfortable that we're competitive, so I don't have an issue at present with investing in the business because we're competitive in our supply price. So I think that's going to be the driving force, and clearly that's where the shale gas in the US becomes a challenge because it is expensive. So it's going to be economics is going to drive it, I'm sure.
Christoph, in the US last week, we saw the big data point on US home building surging to a 15-year high. Generally, all of the sort of underlying data points that sort of drill down into the US economy, the K recovery, starts to feel like it's the K on boats, up and down of the K that the US at least is starting to signal.
What do you mean, the up and down of the K?
Well, that the upper half of the K, where the recovery of the last 6 months has been obvious, the equity markets, professional classes working from home. But now there's a lot of indications unemployment is falling, house building is growing.
Yes, yeah. That fits. I mean, this is just another part of the mosaic of the puzzle, and of the inflation, which shows you an overheated economy and inflation is going to come. This the U.S. certainly is on the rising part of the K. It certainly performed better than the Federal Reserve and others had expected. There is at the same time risk aversion on parts of the policymakers, no desire at all to go out and to say, okay, we scale down the money printing from part of the Fed, or we take back part of the stimulus on part of the Fed, of the finance ministry of the Biden administration. Not at all. Nobody dares touching that. So the wall of money is growing and engulfing everything. And at the same time, you have the most sensitive areas reacting, which is, for example, the housing market. And again, the big question to figure out is, how do you maneuver your assets through that? How is it going to end? And that is relevant in particular also for energy. I mean, you think about this article you had there on shale production. This is private equity money coming in. So these guys will not, be disciplined and stop shale from producing as long as there's all this money sloshing around. But once money gets scarce, once interest rates rise, we may see a reaction on over-leveraged parts of the system, and certainly in the past, shale has been one of them, and I wouldn't exclude that it becomes one again. But the big picture, you're absolutely right. The US is moving full steam ahead, and if they top off the current consumption boost and stimulus, the transfer stimulus, with substantial infrastructure investment as planned, then in the first instance, the gap between the US and everybody else in the world will rise. And in the second instance, it will become an even more interesting game to see whether they can engineer a soft landing to this boom or not. Mark that term. So soft landing is going to be the big phrase in
The
about
soft
6 to 8 months.
landing. It
Oh,
sounds like Elon Musk going to the moon, getting a $2.5 billion contract from NASA overnight, landing softly on the moon. But Christoph, just coming back to the China numbers, obviously massive on the headline level, but in reality, it's coming from a low base, as you pointed out, and quarter on quarter is only a 1% gain. Your thoughts on how it will impact the markets going forward?
yeah, the China number, I would not, the reason that nobody reacted inclusively, no reaction on the oil price as far as I could see, is that this is really just a baseline effect. Just, statisticians call it very low growth a year ago and now a giant jump. But if you put it into, as you did, just in a quarterly context or forward looking, we are still having a situation in China where in the medium term growth has slowed down substantially, and we should expect it more around 6% than around 8.5% in the past. So China is doing all right, but it's still busy with getting itself weaning off from industry and towards more services. It is still harboring a big problem in its financial sector because it is a very highly leveraged economy on several levels, has a lot of what they call zombie banks, people who do lending off the books leverage, which doesn't show up in the bank balance sheets, and a central bank which is very busy trying to sort that out. So there is a problem because most of these cleaning up of the financial sector, which is going on and badly required to accelerate, will mean a substantial slowdown in expenditures and some bankruptcies and partially higher interest rates. So the China economy came out of COVID first, and that means they are now facing some of the adjustment problems first. I would not.
Which seems to be reflected in the equity markets in China. They're not following the Western markets at the moment.
Exactly. Follow the money. So they are worried, and it's of course part of the financial segment in which the clampdown takes place, which is very, very moderate at the moment. So we're looking at China. Don't expect China to be the locomotive which will pull the world ahead. Just expect it to be more dicey than most people realize. And don't expect anything, or don't read anything into these 18% would be my take on it. The locomotive will be the US. And whether they can then decelerate from 120 miles per hour to a normal 50 miles per hour, that's going to be the question for this year and next year.
Walter, one of the challenges coming out of COVID, of course, is in the context of the West, at least, and other places where they've had massive stimulus, is to take that back and start to pay for it, and austerity, tax rates, and so forth. We saw over the weekend in Oman becoming the fourth country in the Gulf now to increase VAT. I think today or yesterday was the first day of that in Oman. The timing of that, of course, must be a bit of a challenge. We saw the Saudis during the height of the pandemic last year go from 5% VAT to 15% overnight. But generally, that fiscal austerity at this time, how challenging will that be, do you think?
Undoubtedly, I mean, it's going to raise prices for everybody, and so that it will hit the population. It's only 5%. It came in on Friday, the 16th, but there's the oil and gas sector is zero. It's exempt. So there are some coverage in there, but it's brand new. So let's see. But certainly, people are suffering at the moment. There is a curfew from 9 p.m. And clearly, that is a big deal to put a 9 p.m. curfew in place during Ramadan, because clearly that's the main time for getting out and about, and for small businesses, particularly small restaurants, getting their business. So the economy is suffering at the moment, and they've made some pretty hard decisions in trying to protect the health service and the people from infections.
Let's go to the survey question for today and give everybody a chance to cast their views on this India outlook. India registered its highest ever single day spike yesterday, over 260,000 infections, and recorded 1,500 fatalities. Can the COVID-19 pandemic still derail the H2 outlook for global oil demand recovery? Uh, these are significant figures, but India, one would say, is not a major oil. Obviously, it's a big one from the point of view of Asia. But so it's this sort of, can this H2 recovery still be derailed is ultimately the question today. And that's something for multiple answers. Christoph, your thoughts looking forward to this week? Obviously, we're going to be still digesting maybe the numbers out of China. Anything else to keep forward guidance on?
Very poor week as far as economic news or events are going. Some, the usual Fed speeches and some inflation numbers from places like the UK, but nothing really on the calendar. Maybe I overlooked it. Quite weak in that respect. So probably a week to reflect on. Coming back to UK. I mean, what I was just thinking about is one is the fact that with the US foot on the accelerator, not letting go. A rising tide, of course, lifts all boats. So for the time being, we should expect this sort of mood change and the numbers ticking up everywhere to continue. But it's probably worthwhile sorting through the rubble a little bit and to spot those economies which are now going up, but which are more vulnerable. For example, some countries in Southern Europe where the debt levels in Italy, debt levels just broke the 100-year record and things like that. Because once the adjustment comes, and if it's not super soft, then people will fall off the wayside, will fall off that train as it takes the brakes. And the question, of course, is which parts of the world, which parts of the economy, which countries will that be? And my suspicion is that most of them we know fairly well.
India, the other big story, sorry, I was just going to interrupt on the other big story from last week that carries into this week, of course, is the Iran talks in Vienna, and they're signaling muted but positive.
I think that was interesting how the Biden foreign policy now shapes up in geopolitics. No? So with Iran, clearly that's on the agenda as an item which they want to be solved. And given the situation, the internal situation in Iran and the elections coming up there and the miserable economic situation, I would suspect they want this solved too, and the European Union always wanted it solved. So that is highly likely that this will have an impact in terms of oil supplies, because it will be resolved one way or another, maybe sooner than we think. This seems to hinge only on Iran. On the other hand, a very tough stand on China and sort of an attempt to put in straight lines in dealings with Russia, put some plugs in the sand, some red lines, I almost said, okay, this is what you can do, this is what you can't do, but not cutting the dialogue completely. And I think that Putin is the man who understands these kind of messages. So when they meet, we are probably seeing some sort of more steadiness in the relationship with Russia, which also would have an impact on energy policy, in the sense that Russia will sort of feel more certain, more comfortable continuing with OPEC Plus and calming the waters there a little bit. The big unknown is how they will deal with China and with countries in Asia where the competition is on for influence, just as the terrible things we're seeing in Myanmar are part of that bigger picture.
Walter, the other outlook for the week ahead will start to get the noise around, the next OPEC meeting now on the 30th of April, only a few days away once again. Your thoughts on the beginning of that noise as people kick the tires on what might be next? Any thoughts on whether a supply gets adjusted upward or downward, given the outlook?
Look, with all the news we've got at the moment, I'd suggest that the deal they struck at the last meeting would make sense to continue that, but they've got a track record of surprising us. So who knows what they're going to do? I just feel as though everything's pointing to, yeah, we're happy with the decisions we made and we're going to stick with them. Would seem to be the answer at present, but we'll see.
I mean, if we see the oil price continue this week, the same kind of climate had last week, where we're again knocking on the doors of $70 a barrel. I mean, the macro outlook, China and the US, two biggest oil consumers in the world, you would think maybe the market needs more oil.
Well, potentially, and maybe they will sneak a little bit more in. But, the Saudis are probably looking for the 60 to 70 mark. The Russians are happy at 60. US positions subtly changing with the dependency in the southern, certainly Texas and areas, and jobs on oil price. So I feel as though the 60 to 70 mark shouldn't be a big deal for them. If it went above that, then maybe that would have an impact. But I feel as though it's around where they would like it to be. You know, the fact that it just dropped off at the end of last week says to me that, okay, maybe a little bit of just weekend trading, but I don't feel as though it's going to jump up unless there's some dramatic news this week that's suddenly different. But my feeling is it's going to hang in where it is at the moment, and that's probably okay.
Let's get the survey result and give Christoph the last word today. So, can the COVID pandemic derail H2 global oil demand recovery? There's still a yes in this room for the potential for that. We did see Christoph at the last meetings last week. Both OPEC Plus and IEA, for the first time in a while, actually revise upward demand recovery. They'd spent many months revising downward. They've now started to turn it the other direction. Your thoughts on that?
I think I agree with what Walter said earlier. What we are seeing are price movements within a corridor. These are durations between 60 and 65, or say 60 and 70 to make it wide enough. Nobody at this point really has the intent, well, you never know, to push the prices much higher and trigger another sort of chain of events. OPEC Plus needs to make sure that it gets control over spare capacity. So this was in inventories, and inventories are driving down nicely. It now is in their own hands, and so they can increase a little more, and they have to look left to Libya and right to Iran. But that's a manageable proposition. The recovery is in choppy waters, but the overall current is clearly towards recovery. So we should expect now this massive spare capacity being the next target and coming down gradually. And overall, remember, so my stand is very clear. I think that COVID is over, not in the sense that the pandemic may not surprise us and be with us for a while, but in the sense that with a vaccine, the world will gradually relegate it to the position the flu has in our lives. And hopefully, if there's no mutation coming. So I'll take a bet on that, a hopeful bet. But remember when it started, one of the biggest insights ever anyone had was that this is not the end of the world, but that it will mostly accelerate already existing trends. And that's exactly what it did in many ways. Now coming out of it, so we have to look around, and one way to understand the world is probably to see where have these trends actually run ahead of themselves, where have they been sort of just accelerated in the right directions, and where is an acceleration still missing. You see a big economy like India going down the tubes, maybe their economy wasn't deregulated enough all along, and their bureaucracy efficient enough. You see the European Union being incompetent, I mean, to a degree nobody had expected in vaccinating its own people. Maybe the bureaucracy wasn't that great, and maybe the distance between the accelerator and the wheels was too large in the European all along. I think this is a very plausible thing. So then you see where the laggards are, and then you see where the people are running ahead of themselves, like the UK after Brexit. That's a useful lens, I think, to look at these longer term developments if you're facing a world with a week without too much daily news.
Well, there's certainly going to be more daily news the coming week on equity earnings results. And I think, as Adi Imsirovic shared with us his views last week, that watch equities and forget about 18% on China, 50+% on Goldman Sachs and others will be driving this market, I think, in the coming days, and certainly keep an eye on that. And as he said, could drive it up to 70 if we continue to see those outperforming equity results. Christoph, as always, thank you so much for your time this morning. And Walter, thank you as well for joining us this Sunday. Everybody else, thank you. And we look forward to catching up with you in the coming days to see where this week goes. Thank you, everybody, and have a great week ahead. All the best.
Thanks, Sean.